Every year, homeowners overpay property taxes because nobody told them what to check. The county sends the bill, you pay it, and if something is wrong, they're probably not calling to fix it. I'm Tiffany Phillips, CPA and tax strategist, and I've seen homeowners overpay hundreds or even thousands of dollars because an exemption was missing, a property record was wrong, or the owner never challenged an inflated assessment. Because these programs are local, verify every benefit, qualification, and deadline with the assessor where the property is located. In this video, I'm going to show you 6 legal ways homeowners and real estate investors may be able to lower, freeze, defer, or challenge their property taxes. One of these takes less than 10 minutes to check. Another may involve a deadline that costs you an entire year of benefits or limits how far back you can correct the mistake. And strategy number 4 surprises many real estate investors because it involves the way the property is classified, not just what the property is worth. Let's start with the opportunity that's easiest to overlook, your homestead exemption. A homestead exemption generally applies to the property you use as your primary residence. Depending on the state and local rules, it may reduce your taxable value, limit future increases in assessed value, or provide other protections for qualifying homeowners. But the exemption isn't automatic everywhere. Some jurisdictions enroll eligible homeowners automatically. Others require an application. Some have strict filing deadlines. Others allow late filing or limited retroactive relief. You can't assume the exemption is active simply because you live in the home. Here's what I would actually do. I'd go to the county assessor or property appraiser's website and pull the property record. Then I'd check whether the property is classified as a primary residence and whether the homestead exemption is listed. I'd check the assessed and taxable value, and I'd look for any assessment cap or limitation connected to the property. Market value, assessed value, and taxable value are not the same number. Your exemptions generally reduce the taxable value, the number local tax rates are applied to. Most homeowners never even look at the county property record. They look at the final bill, see the amount due, and pay it. But the record behind that bill is where you may find a missing exemption, an incorrect classification, or a property detail that's increasing the amount you owe. 2 homes on the same street can have completely different property tax bills because of differences in exemptions, assessment history, ownership, classification, or local caps. Let me give you an example. Susan bought her home 5 years ago. She assumed that because she had lived there continuously, the county had automatically recognized it as her primary residence. She never checked the property record. When she finally reviewed it, the home was still listed as non-homestead. That meant she had missed the exemption for multiple years. Whether Susan can recover prior year benefits depends on the rules where she lives. Some jurisdictions allow limited corrections, some don't, some have specific deadlines. The lesson is simple, don't wait 5 years to look. Pull the record this week. It may take less than 10 minutes, and it could be the highest paying 10 minutes you spend all year. Now let's move to the second opportunity, programs for seniors, disabled homeowners, veterans, and lower income property owners. The easiest way to evaluate these programs is to ask 2 questions. Do you qualify because of who you are? And do you qualify because of your household income? The first category may include age-based programs, disability exemptions, veteran benefits, or benefits for surviving spouses. The second may include income-based reductions, credits, circuit breaker programs, or deferrals. These programs aren't identical from one state or county to another. Some provide an exemption, some reduce the assessed value, some freeze the assessment, some provide a credit or rebate, and some defer the payment, which means the tax is postponed rather than forgiven. That distinction matters. A property tax deferral can improve your cash flow today, but the deferred amount may become due when the property is sold, transferred, or no longer qualifies. There may also be a lien against the property, and interest may apply depending on the program. So if someone says you can stop paying your property taxes, ask a few more questions. Is the tax being eliminated? Is it being deferred? Does the balance accrue interest? Does it affect refinancing? What happens when the owner dies? What happens when the property passes to the heirs? Let's look at Kurt. Kurt is retired and owns his home outright. His income is lower than it was during his working years, but the property tax bill continues to rise. Depending on the rules where he lives, Kurt may qualify for a senior exemption, an income-based program, an assessment freeze, or a deferral. The right program could make a meaningful difference in his annual cash flow, but Kurt needs to understand the long-term result before choosing a deferral. The immediate savings need to be evaluated alongside his estate plan, his equity, and his family's future plans for the property. Veteran-related programs can also be substantial, particularly for qualifying disabled veterans. But eligibility may depend on the disability rating, ownership, occupancy, and the state's specific requirements. Income-based programs can use a different definition of income than your federal tax return. Retirement income, Social Security, rental income, interest, and dividends may all be included depending on the program. So don't rely on a social media post that says if you make less than this amount, you qualify. Read the actual requirements, check the filing deadline, and apply separately for each program that may be available. Filing an appeal doesn't automatically enroll you in a senior exemption. Applying for a homestead exemption doesn't automatically challenge an inflated assessment. These are separate processes. Now let's move to the third strategy, because this is where you can challenge the number itself. You don't have to prove the county was wrong on purpose. You need to show that the assessment doesn't reflect the applicable facts or valuation rules. That's the basic idea behind a property tax appeal. You may have grounds for an appeal if the property record contains factual errors. The square footage may be wrong. The number of bedrooms or bathrooms may be incorrect. The county may show a finished basement that isn't finished, or the property may be listed as renovated when it needs significant repairs. The assessor may have relied on sales that aren't comparable. Or similar properties may have lower assessments without any reasonable explanation. An appeal isn't a complaint about the amount of money you want to pay. It's an evidence-based argument that the assessment or classification doesn't reflect the applicable facts. That means you need documentation. Comparable sales, photos, inspection reports may matter, so could repair estimates and property records. A market analysis from a real estate professional may help, although each jurisdiction has its own rules about acceptable evidence, and the deadline is absolutely critical. In some areas, you have a limited period after the assessment notice is mailed. In other areas, there may be an informal review before a formal hearing. If you miss the deadline, you may have to wait until the next assessment cycle. Let me give you an example. Susan's property record says the home has a renovated kitchen, updated bathrooms, and a finished basement. In reality, the kitchen was damaged by a water leak, the bathrooms need to be renovated, and the basement is unfinished. Susan may already have a legitimate basis to request a correction or appeal the assessment. She doesn't need to exaggerate the condition. She needs to document the facts and submit the evidence before the deadline. Correcting just one false feature, a finished basement, an extra bathroom, or a renovation that never happened can reduce the value the county is taxing. Here's where people mess up. They search for a generic property tax appeal form, submit a complaint without supporting documentation, and then conclude that appeals don't work. An appeal is a process, not a magic form. The quality of the evidence matters, the timing matters, and the argument needs to connect to the valuation method used in that jurisdiction. Before I show you the fourth strategy, let me point out one mistake I see every year. A property owner receives a higher bill and assumes the county must have raised the tax rate. Sometimes that's true, but the increase may also come from a change in classification, a missing exemption, a reassessment after a transfer, a change in property use, or an error in the property record. The information gets thick here, and the owner only looks at the final bill. I look at the record behind the bill. That record tells you where to investigate. Now here's where real estate investors need to pay close attention. The fourth strategy is property classification. A property may be classified as residential, commercial, agricultural, vacant land, multifamily, industrial, or another category under local law. The classification needs to match the actual use and the legal requirements. Certain agricultural, open space, conservation, or special use classifications may receive preferential treatment, but you can't claim a special classification simply because someone called it a loophole online. The property needs to qualify, the activity needs to be genuine, the records need to support the claim, and the consequences of changing the use need to be understood in advance. In some jurisdictions, changing the use can trigger rollback taxes. That means the government may recalculate prior taxes for years when the property received a preferential assessment. Let's look at Kurt again. Kurt owns a large parcel that has historically qualified for an agricultural classification. He decides to subdivide part of the land and begin development. The portion still being used for a qualifying purpose may be treated differently from the portion being developed. The development timeline may matter, the classification may change, and prior tax benefits may be subject to recapture or rollback rules. Kurt needs to review the property tax consequences before making the change, not after the new bill arrives. This is also why real estate investors need to be cautious when converting properties from one use to another. A rental property may become a primary residence. A primary residence may become a rental. Vacant land may become commercial property. Agricultural land may be subdivided. Each change can affect the assessment and eligibility for prior exemptions. Now, strategy 5 can turn an innocent deed transfer into an expensive property tax surprise. A lot of real estate investors own property through an LLC, partnership, trust, or another entity that may be appropriate for liability protection, financing, management, or estate planning. But transferring a property can affect property tax treatment. In some states, a homestead exemption may not be available when a primary residence is owned by an LLC. In other states, a qualifying trust may still allow the exemption if the person occupying the home meets the requirements. A transfer may also trigger reassessment, transfer taxes, documentary taxes, or a review of existing exemptions. If there's a mortgage, the loan documents may create separate issues. So if someone tells you to move your home into an LLC because it's better for taxes, pause before signing anything. The structure that makes sense for an investment property may be completely inappropriate for your primary residence. The structure that works in one state may create a problem in another. An LLC is a tool. It isn't automatically a tax strategy. Before transferring the property, ask what happens to the homestead exemption, whether the transfer triggers reassessment, whether there are transfer taxes, how the lender will treat it, and whether the structure fits your actual goal. That one conversation can prevent an expensive mistake. Strategy 6 is auditing every line of the property record after a major property event. That means checking the record after a purchase, renovation, subdivision, inheritance, ownership change, or conversion between personal and rental use. Start with the ownership information. Check the mailing address, the property use, check the land size and the building size. Note the number of bedrooms and bathrooms. Check the exemptions and the classification. Verify whether a prior owner's exemption or classification was carried forward incorrectly. This is especially important after a purchase. Don't assume the prior owner's classification transfers automatically. If you converted a primary residence to a rental, don't continue claiming a homestead exemption simply because it was on the property before. If you bought a rental that used to be someone's primary residence, check the record and make sure the current classification reflects how you're actually using the property. If you inherited a property, review the record before making changes, especially if the property was receiving an exemption, assessment cap, or special use classification. If you renovated the property, check whether the county added improvements that weren't completed, recorded the wrong square footage, or failed to update the property after a partial demolition or major repair. If you subdivided the property, verify that the parcels, land sizes, ownership, and classifications are accurate. The property record is the starting point for the bill. A mistake at that level can affect every later calculation. And remember, an appeal challenges the assessment through the applicable appeal process. Strategy 6 is the audit you perform after a major event so you can catch errors before they become an expensive pattern. For commercial and multifamily property, the assessor may use income, expenses, vacancy, and capitalization rates. If those assumptions are wrong, the assessment may also be wrong. That means investors should review rent rolls, operating statements, leases, vacancy assumptions, repair costs, and comparable properties when the local process allows that evidence. Now, if I owned property and wanted to review my tax position this year, I'd download the current property record and the prior year record. I'd compare the assessed value, taxable value, exemptions, classification, ownership, and property characteristics. I'd also look at the assessor's website for available exemptions, reductions, freezes, deferrals, and appeal procedures, and write down every relevant deadline. I'd need to identify whether the property is a primary residence, rental, commercial property, agricultural property, or a combination. And I'd definitely review whether the current ownership structure affects eligibility. I wouldn't transfer the property into an LLC or trust without checking the local consequences first. And then finally, I create a calendar reminder for the next assessment notice and filing deadline. This provides a shield against missing any dates. Don't wait until after the filing window closes to discover a missing exemption, or until you learn that the property record has been wrong for years. Don't transfer a home into an LLC and discover later that the homestead treatment changed, or convert agricultural land to another use without understanding the rollback tax consequences. These are planning issues and they need to be addressed before the deadline or before the transaction. Now, reducing your property tax bill is only one part of your real estate tax strategy. You also need to understand depreciation, cost segregation, passive activity rules, repairs versus improvements, interest expense, and the way your rental activity connects to your overall income. An investor may successfully appeal a property tax assessment and save several $1,000s per year. That's helpful. But when that same investor purchases or renovates a property, the larger opportunity may involve how the costs are classified when improvements are placed in service and whether accelerated depreciation is available. Some investors may save more through one properly prepared cost segregation study than they'll ever save appealing property taxes. That's why the next video in this watch chain is going to focus on cost segregation. We'll look at how a cost segregation study can identify components of a building that may qualify for shorter recovery periods instead of being depreciated as one long-term building asset. When it's properly prepared and supported, cost segregation can accelerate deductions and improve cash flow for the right investor, but it has to fit the property, the investor, and the broader tax plan. So here's your homework. Spend 10 minutes this week downloading your property record, check the classification, check the exemptions, note the taxable value, verify the ownership, then calendar the deadline for correcting or appealing the assessment. Remember Susan, her mistake wasn't buying the wrong house. It was never checking the record behind the bill. If you're a homeowner or real estate investor, like and subscribe to the channel, then comment property below. Tell me what state your property is in because I want to know which state-specific property tax topics I can help you with. In the next video, I'm going to show you how cost segregation can accelerate depreciation on qualifying real estate, where the biggest opportunities are and where investors need to be careful. Don't miss it. For more inside tips on how to make the tax structures work for you, grab my book, Your Biggest Expense. It's linked in the description. Thanks so much for watching. And remember, it's not what you make, it's what you keep. So keep more.